Did you have any other specific questions at the moment? As just before we proceed, is there anything else you want to
I
ask?
think I'm good. I'm glad we went into a little bit more that it's the insurance. So is every IBC different then? Because everyone's mentality is a little different, or is it
Everyone will
typically
implement
insurance?
it. Yes, you can do it with anything because it's a concept, right? You
Right.
could do it with a shoebox full of cash. It's just every time you use that cash, you're interrupting the compounding. And so that's
Well,
one
there is no
thing.
compounding if it's in your shoebox.
Yeah, that's a good point. It's inflating, right?
Right.
Or deflating.
You're actually losing money.
Yeah, right. And so this kind of counteracts all of those
Right.
things and allows you to operate on an uninterrupted compounding basis, and then all of the future benefit of all that, there's significant tax benefits. So it makes it makes whole life insurance designed correctly to be a very optimal vehicle to do it, but it's just a mindset.
Yeah.
Like you can do it with anything.
One of the things that's so fun about it when you get into it, so we learned about IBC 30 years ago and set up our first policies then, but it's really fun. We don't have kids, but I always thought like life insurance is so cheap for children. And if you can get them started and you can use that as a banking policy, and then suddenly they're of age and you can turn that, you're a big legacy person. Mm-hmm. The episode we had you in before, we got really deep into legacy. Man, like that totally creates a fascinating legacy that like you might need a mortgage to buy your house, but if you set something up like that for their kids, they might not ever need a mortgage.
I just had a meeting with some clients who are getting each of their kids set up with $10,000 a year in for their banking system. And what this means is that one of their kids is not yet 1 and the oldest is 6. So what this means is when they all turn to about 18 to 20 and they hand over these banking policies to their kids, they'll be paying roughly around $4,000 or $5,000 a year into these policies. As soon as that kid at 18 years old writes that check for $4,000 to the life insurance carrier, they'll get the opportunity to use an increase. That $4,000 will change to about $15,000 as soon as they write that check. Now, if I'm 18 and I have an opportunity to turn 4,000 to 15, I'm excited. Right? Like how much better can we do when we never interrupt that compounding?
Yeah.
It's
Yeah.
mind-blowing.
So I'm sorry, I didn't mean to derail it.
No,
but I did,
no.
Especially because it
good
was
thing to
fun
bring
because
up.
we
I
had
wouldn't have
talked about
thought.
legacy.
Children.
When
Yeah.
you were here, that was a big part of what we were talking about. And so that is one of the things that's super cool because we had talked about you have to teach kids discipline and motivation and that momentum works and all of these different things. And so if you teach that in a fun way, that then you can be working on that.
Because like it's the same thing if we use, is it the 529 plans that are the college
Right.
savings things,
Yeah.
right? So there's all vehicles that you can do things with, but if you don't go to college and blah, 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 there's all these, issues. It's the same thing. It's the discipline is at the heart of it. It's just where are we going to store it?
And those plans are siloing money.
Yeah,
They're
right.
taking it away and taking
They're-
it out of flow. And there's
Yeah.
no looping.
So they can
You lose the loop.
access it. Yeah.
Yep.
Yeah, and one more thing on that point, Kellyanne, is that even though the infinite banking concept is something that can be applied to other vehicles, if you took like the 12 most ideal account types, like or benefits for various accounts, you start comparing accounts. We know whether it's stock accounts or real estate accounts or savings accounts or CDs or life insurance. And if you apply those 12 ideal benefits to every account and you start comparing apples to apples, most accounts that you try to apply the infinite banking concept to will satisfy some of those benefits, like, 4 or 5 of the benefits, and those benefits can be anything from, tax deferred, tax-free growth, collateralization opportunity, no loss risk or no loss prevention, safe harbor. There's all these different kinds of things that goes into these account types. The only one that actually satisfies 11 of the 12 ideal benefits from an account, apples to apples account opportunity, is actually a whole life insurance policy like Kyle's talking about. And that's why the industry has applied this concept primarily to the life insurance world, because that contract on a legal basis and the way that it just exists in the financial world, there is no equal. It's just superior.